Right now, somewhere on the internet, someone is watching a video of a 26-year-old in a Lamborghini telling you that day trading changed their life. And somewhere else, someone just quietly hit $1 million in their retirement account, and they did it by barely touching their portfolio for 30 years. These two people made opposite choices. One of them is the exception. One of them is the rule. The financial world is full of three types of investors, and most people never stop to understand what truly separates them. There are day traders, people who buy and sell stocks within the same day, sometimes within seconds, trying to profit from tiny price movements. There are swing traders, people who hold positions for days or weeks at a time, riding short to medium-term waves in the market. And there are buy and hold investors, people who buy assets and hold them for years, sometimes decades, mostly ignoring the noise in between. Three strategies, three completely different lifestyles, three very different outcomes on average. By the end of this video, you will know exactly what each strategy involves, what the data actually says about who wins and who loses with each one, and most importantly, which approach makes the most sense for your life, your personality, and your financial goals. And just so we're clear before we go any further, nothing in this video is financial advice. It's here to educate, not to tell you what to do with your money. Always do your own research before making any financial decision. Now, let's get into it. Day trading is exactly what it sounds like. You buy a stock, or a currency, or a futures contract, and you always sell it before the market closes that same day. You never sleep on a position. When the market closes, you're out. Clean slate every single day. The goal isn't to find a great company and own a piece of it. The goal is much simpler. Find something that moves, get in at the right moment, get out at the right moment, and pocket the difference. Sounds exciting, right? That's the point. Day trading is powered almost entirely by technical analysis. That's the practice of reading price charts and patterns to predict where a stock is going next. Day traders aren't asking, is this a good company? They're asking, is this price about to go up or down in the next 45 minutes? They use things like momentum indicators, support and resistance levels, and news catalysts, things like earnings reports or economic data releases, to identify trades. When a company reports earnings that beat expectations, the stock can spike. Day traders are trying to be in before that spike and out before the reversal. The typical day trader's toolkit includes real-time data feeds, sophisticated charting platforms, and a very fast internet connection. Speed is everything in this world. We're not talking about being fast. We're talking about competing against high-frequency trading algorithms that can execute a trade in microseconds. Literal microseconds. Now, here's something that catches a lot of new traders off guard. Many day traders use what's called a margin account. That's an account where you borrow money from your broker to increase your buying power. And that borrowed money cuts both ways. Leverage, using borrowed funds to amplify your position size, can make your gains larger, but your losses are larger too, in exactly the same proportion. A bad trade with leverage doesn't just hurt, it can wipe out weeks of wins in a single session. And on a really bad day, you can lose more than you started with. So, who actually makes money day trading? The honest answer is, not many people. We'll dig into the numbers in detail later. But the people who do succeed tend to share a few things: exceptional discipline, deep market knowledge, ironclad emotional control, and, this matters more than they'll admit, a fair amount of luck combined with the resources to survive the learning curve. Day trading is intense. It's a full-time job. It demands your complete attention from the moment the market opens to the moment it closes. It is not passive. It is not relaxed. And it is not for everyone. Now let's talk about the strategy that doesn't get nearly enough attention. Swing trading sits in the middle of the spectrum, between the frantic pace of day trading and the patient stillness of buy and hold. A swing trader is not trying to catch the move within a single day. They're trying to catch a swing, a meaningful price move that plays out over days, sometimes weeks. They buy when they believe a stock is at the bottom of a short-term pullback, and they sell when they believe the move has run its course. The key word in swing trading is cycle. Markets don't move in straight lines. They go up, pull back, go up again. They establish higher highs and higher lows in an uptrend, and lower highs and lower lows in a downtrend. Swing traders are trying to identify where in that cycle a stock currently sits and position themselves accordingly. To do that, they rely heavily on technical analysis tools. Things like moving averages, which smooth out price data to reveal the underlying trend direction, or the RSI, which stands for Relative Strength Index, a momentum indicator that tells you whether a stock has been overbought or oversold relative to its recent price history, or the MACD, which stands for Moving Average Convergence Divergence, an indicator that helps identify when a trend is gaining or losing momentum. These tools help swing traders identify what are called support and resistance levels. Support is a price floor, a level where buyers have historically stepped in and pushed the price back up. Resistance is a price ceiling, a level where sellers have historically pushed the price back down. Swing traders build their entry and exit strategies around these levels. Here's what makes swing trading meaningfully different from day trading in practice. You don't need to be glued to a screen all day, because you're holding a position for days or weeks, not minutes. You can do your analysis in the evening, place your orders, set a stop-loss order to automatically cap your downside, and then go about your normal life. This makes swing trading far more compatible with having a job, a family, or a life outside of financial markets. There are a few core swing trading strategies worth knowing. The most common is the trend pullback. You identify a stock in a clear uptrend, wait for a natural short-term pullback, and enter as the trend resumes. You're not fighting the overall direction. You're joining it at a better price. There's also breakout trading, where you look for a stock that's been moving sideways in a narrow range for weeks, and you enter when the price finally breaks out above that range on strong volume. The idea is that the buildup of pressure leads to a meaningful move once it's released. And there's support and resistance trading, simply buying near a proven floor and selling near a proven ceiling. Beyond those three, there are two more strategies that serious swing traders use. The first is Fibonacci retracement. After a big price move, markets often pull back by a predictable percentage before continuing in the original direction. Fibonacci retracement uses a set of specific mathematical ratios: 23.6%, 38.2%, 61.8%, to identify exactly where that pullback might stall and reverse. It sounds complex, and honestly, used properly, it is. There's a lot of nuance to getting it right. The second is chart patterns, recognizable formations that appear on price charts and signal either a reversal or a continuation of the current trend. Things like head and shoulders formations, double tops and bottoms, flags and pennants. Experienced traders learn to spot these shapes and use them as entry signals with built-in risk management. Both of these strategies are genuinely fascinating, and both are worth an entire dedicated video to do them justice properly. If you want us to go deep on Fibonacci retracement and chart patterns in future videos, hit the like button and subscribe so you don't miss them when they drop. It's the clearest signal you can send us that these are the topics you want covered next. Swing trading isn't without its risks. You're holding overnight, which means something can happen after hours. An earnings miss, geopolitical news, a surprise announcement that moves your stock against you before you can react. That overnight risk is real. But compared to day trading, the pace is more manageable, and the strategy is learnable without needing to quit your day job to do it. For a lot of people, particularly those who are curious about active trading but don't want it to consume their lives, swing trading represents a genuine middle path. Now let's talk about the strategy that has made more ordinary people wealthy than any other approach in the history of investing. Buy and hold is exactly what it sounds like. You buy stocks, or funds that hold hundreds of stocks, and you keep them. Through market crashes, through recessions, through periods where the news makes it feel like the world is ending, you hold. The philosophy behind buy and hold is grounded in a simple, well-documented truth. Over long periods of time, the stock market has historically trended upward. Not every year, not in a straight line, but over decades, equities have delivered higher returns than virtually any other asset class, including bonds, real estate, or cash sitting in a savings account. The bet isn't on any single stock or any single moment. The bet is on the long-term growth of the economy. Legendary investors like Warren Buffett and Jack Bogle, the founder of Vanguard and the man who popularized index fund investing, have both spent decades arguing that, for most people, a patient buy and hold approach will outperform the vast majority of active trading strategies, especially after accounting for fees and taxes. Here's a concrete example that makes this real. Imagine someone who bought 100 shares of Apple stock in January 2008, just before the most serious economic recession in modern history, at roughly $7 a share. Total investment, about $700. If they had just held those shares through the 2008 financial crisis, through multiple corrections, through years of volatility and doubt, and simply not touched them until 2025, those shares would have grown to be worth approximately $27,000. That's a return of nearly 3,800% in just over 17 years. Not because they were clever traders, not because they watched charts every morning, because they bought a quality asset and left it alone. Buy and hold also comes with a tax advantage that most active traders overlook. When you hold an investment for more than a year before selling, you qualify for long-term capital gains tax rates, which are significantly lower than the short-term capital gains rates that apply to day traders and frequent swing traders. Every time a day trader closes a profitable position, they're potentially handing a larger slice of those gains to the tax authority. Compound that effect over years and decades, and the tax drag on active trading strategies becomes a serious headwind. Now, is buy and hold completely passive? Almost, but not entirely. It still requires you to make smart initial decisions about what you're buying. A diversified index fund, one that tracks the entire market, requires almost no ongoing management. Individual stock selection requires more judgment, and in both cases, you still need the emotional discipline to not sell during a downturn. That last part is harder than it sounds. We'll come back to it. We've now walked through all three strategies: what they are, how they work, and what they require from you in practice. But we haven't yet talked about the one thing that should matter most to your decision: the actual numbers. What does the data say about who wins and who loses with each approach? That's exactly where we're going next, and the answer might surprise you. Let's talk about what the research actually shows. Starting with day trading. Studies consistently find that less than 10% of day traders are profitable over the long term. Let that sink in for a moment. That means over 90% of people who try day trading lose money over time. And it gets more specific than that. Research shows that even among profitable day traders, a significant portion still fail to earn what they could have made working minimum wage when you account for the hours spent, the capital risked, and the losses absorbed. The top performers, the people in the 99th percentile, can earn genuinely impressive incomes. But they represent a tiny fraction of all day traders. For most people, the experience looks like this: initial excitement, a few lucky wins that build false confidence, escalating position sizes, a catastrophic loss, and an account that never recovers. What makes it so hard? Several things are working against you simultaneously. Transaction costs eat into your margins with every trade. Emotional decision-making, fear, greed, revenge trading after a loss, destroys discipline. And the rise of high-frequency trading algorithms means that individual retail traders are competing against machines that can process information and execute orders faster than any human possibly can. Now, swing trading. Honest data on swing trading success rates is harder to come by because swing traders operate across such a wide range of styles and time frames. What we can say is this: swing trading is genuinely more survivable than day trading. The pace is slower, the decisions are less emotionally pressured, and there's more time between trades to analyze what went wrong and adjust. That said, most independent research still suggests that the majority of retail swing traders underperform a simple, passive index strategy over time, especially after accounting for taxes, fees, and the psychological cost of managing active positions. Swing trading can work. There are people who do it successfully, but it requires real skill, a genuine edge in reading market patterns, and consistent discipline. It's not something you can do casually and expect to beat the market. And now, buy and hold. Here's where the data becomes genuinely striking. The S&P 500, an index tracking 500 of the largest companies in the United States, has delivered an average annualized return of roughly 10% per year over the long run, before inflation. That's not every year. Some years are down 40%, but over long stretches of time, the trend has been relentlessly upward. A passive index investor who simply bought the whole market, reinvested dividends, and held through every storm has historically outperformed the vast majority of actively managed funds, including professionally run hedge funds, with teams of analysts, sophisticated technology, and billions of dollars at their disposal. The research on this is overwhelming. Study after study, over decade after decade, finds the same thing. Most active strategies, run by professionals and amateurs alike, fail to beat a simple, passive index fund over a long enough time horizon. Now, does that mean active trading is never worth it? Not necessarily. Context matters. Time horizon matters. Goals matter. And some genuinely skilled traders consistently generate returns above what a passive strategy would produce. But for the average person, the data is clear. The less you trade, the better you tend to do. So, how do you actually decide? Here's the honest framework. First, ask yourself about time. Day trading requires your full, undivided attention during market hours. That is not an exaggeration. If you have a job, a family, significant responsibilities, day trading is not compatible with your life. Period. This isn't a judgment, it's just math. You cannot effectively monitor dozens of positions, news feeds, and price charts while also doing anything else. Swing trading requires a few hours per week, mostly in the evenings when markets are closed, and you can do your analysis in peace. It is compatible with a regular life, as long as you're willing to put in consistent effort. Buy and hold requires almost no ongoing time at all once you've made your initial investment decisions. Set up automatic contributions, invest in a diversified fund, and check in a few times a year. Second, ask yourself about capital. If you're just starting out and you have a modest amount to invest, say a few $1,000s, day trading is a precarious place to begin. The risk of losing your entire starting capital while you're still learning is very real, and using leverage before you have the skills to manage it can accelerate that outcome significantly. Swing trading is more accessible from a capital standpoint. You don't need to be wealthy to start. Buy and hold is the most accessible of all. You can start with whatever you have, add to it regularly over time, and let compound growth do the heavy lifting. Third, and this is the one most people ignore, ask yourself about psychology. Day trading will test your emotional discipline in ways that very few other activities in life will. A single bad hour can destroy a week of gains. The temptation to revenge trade, to make bigger and riskier bets to win back losses, is overwhelming for most people. If you are someone who struggles with impulsivity, anxiety, or emotional decision-making under pressure, day trading is likely to make you miserable. Swing trading requires patience and the ability to sit with open positions overnight without panic. You need to be comfortable with uncertainty. Buy and hold requires a different kind of discipline. The ability to do nothing when markets are crashing and every instinct is screaming at you to sell. History shows that the investors who panicked and sold at the bottom of the 2008 financial crisis, or during the COVID crash in 2020, locked in their losses, while those who held on recovered and then went further than before. Here's a practical framework to keep in mind based on where you are in life. If you're in your 20s or 30s, in the wealth-building phase of your life, time is your greatest asset. Compound interest over 30 years is staggering. Passive index investing captures that almost automatically. If you want to try swing trading on the side with a portion of your portfolio, that's a reasonable exploration, but protect the core. If you're in your 40s or 50s, the math still favors patience over activity. You likely have assets worth protecting now, not just building. The tax efficiency of buy and hold becomes more valuable, not less. If active trading interests you, keep it compartmentalized. A defined allocation you're comfortable potentially losing, separate from your long-term wealth. If you're approaching retirement or already there, preservation becomes the priority. This isn't the time to be learning day trading. Volatility has a different meaning when you need your money to last, not to grow as aggressively as possible.
Here's what it all comes down to. Day trading is glamorous, fast-paced, and almost statistically designed to lose you money. A small number of skilled, disciplined people succeed at it. Most don't. Swing trading is a legitimate middle path, active enough to be engaging, patient enough to be manageable. But it still requires real skill, consistent effort, and the humility to know that most active strategies underperform the market over time. Buy and hold is boring, genuinely boring. And for most people, it is the single most reliable path to building real lasting wealth over time. The strategy that looks like the least work often produces the best results. That's not an accident, it's a feature. So here's the question I'll leave you with. When you picture the kind of investor you want to be, are you picturing the life you genuinely have or the life you think you're supposed to want? The answer to that question matters more than any indicator, pattern, or trading strategy you'll ever learn. If you want to go deeper, a great next step is understanding exactly how compound interest works over time and why starting early is the single most powerful financial decision most people can make. Drop a comment below and let us know which of these three approaches resonates most with where you are right now.